Let's talk about financial modeling. I know. The term itself can sound super intimidating, right? You probably picture these massive, insanely complex spreadsheets. But what if we thought about it differently? What if it was less like rocket science and more like cooking? Today, we're going to step into the financial modeler's kitchen. We're going to break down some of the most powerful recipes in finance into simple, easy-to-digest steps. You'll see how the pros turn raw data into some truly brilliant financial insights. And look, this whole cookbook thing, it's not just me trying to be clever. The very source material for this whole analysis, a classic textbook on the subject, literally calls itself a cookbook. So that's going to be our theme. We are not getting lost in some dusty, abstract theory. Nope. We're focusing on the practical, hands-on recipes that real professionals use every single day to answer some really big questions about the market.
All right, first up on our menu, recipe number 1 tackles maybe the biggest question in all of business. How much is a company really worth? I mean, think about it. Whether you're an investor trying to decide if a stock is a good buy, or a CEO thinking about buying another company, this is always square one. You need a solid recipe to turn a whole mountain of financial data into one single defensible number. And a super classic recipe for this is the discounted cash flow model, or DCF for short. At its heart, it's a really powerful but simple idea. A company's value today is all about the cash it's going to make in the future. That's it. A DCF model is just a way to guess at all that future cash and then discount it to figure out what it's worth in today's money. Because $1 tomorrow is worth less than $1 in your pocket right now. The model just applies that same logic to an entire business.
So where do we get the ingredients for this recipe? Well, they come straight from a company's financial statements, just like this simplified balance sheet. All these numbers you see, the assets, the liabilities, these are the raw materials. Modelers take these and calculate a really key ingredient called free cash flow. Think of it like this. After a company pays all its bills and invests in its future, the cash that's left over in the drawer, that's the good stuff. That's the cash that truly represents its value. It's how we turn boring accounting data into a real economic insight. Okay, so our next recipe is a little more, let's say, gourmet. We've figured out how to value a company based on what it is today. But how in the world do we put a price on something that hasn't even happened yet? Like, say, the option to buy a stock at a certain price a month from now. This is where financial modeling gets really interesting. It's not just about valuing the present, it's about pricing the future. So the two basic ingredients here are what we call call and put options. A call option gives you the right to buy a stock at a price you agree on today. You want this if you're betting the stock's price is going to shoot up. A put option is just the opposite. It gives you the right to sell at a set price. You'd want that if you think the price is about to tank. It's really that simple. Calls for up, puts for down. So how do we actually cook up a price for these options? Well, we use a super famous recipe called the Black-Scholes model. And listen, if you ever Google the formula, it looks like something out of a sci-fi movie. Totally terrifying. But the ingredients, they're actually surprisingly simple. You just need 5 things. What the stock is trading for right now, the price you can buy or sell it at, that's the strike price, how much time is left before the option expires, how jumpy the stock's price is, we call that volatility, and finally, the risk-free interest rate. You plug those 5 ingredients into the recipe, and bam, it spits out a price for the option. We've valued a company, and we've priced a bet on the future. But, any good chef will tell you, it doesn't matter how great your food is if you burn down the kitchen, right? In finance, that means managing your risk. It's not enough to know how much money you could make. You absolutely positively have to know how much you could lose. And that brings us to our third and maybe our most important recipe. So let me just ask you straight up, what's your worst case scenario? Seriously, if you're managing millions or even billions of dollars, that is not a philosophical question, it's a question you have to answer with a number. Your board wants to know, your investors want to know, the regulators definitely want to know. And financial modeling gives us the recipe to find that number. And the recipe for that answer is called value at risk, or VAR. It sounds complicated, but here's all it is. If a bank says, our one-day VAR is $1 million at 95% confidence, what they're really telling you is this. Look, on 95 out of 100 days, we're pretty sure we're not going to lose more than $1 million. It's a way of putting a number on your potential bad days.
And this chart here, it's the perfect way to picture it. See that big bar? That's, 95% of the time. Things are pretty normal. You win some, you lose a little. But then you've got that small bar on the end. That's the scary stuff. That's the 5% chance of a really bad day. VAR is just the number that says, okay, this is where the bad days begin. It's like a smoke detector for your portfolio.
Okay, we've gone through 3 huge recipes: valuation, options, and risk. But where is all this cooking actually happening? What's the kitchen? Well, for pretty much every financial pro on the planet, the kitchen is Microsoft Excel. It is the ultimate set of pots, pans, and mixing bowls. So let's do a lightning-fast tour of a few of the must-have tools in that kitchen.
First up, the PMT function. Ever wonder how your car payment or your mortgage gets calculated? This is the little magic button that does it. It's simple, it's powerful, and it's used all the time in both personal finance and the big corporate world.
Next, we've got NPV, which stands for net present value. Hey, remember our first recipe for valuing a company, the DCF? Yeah, this is the engine that makes that whole thing run. It does all the hard work of figuring out what future money is worth today. Absolutely fundamental. Then there's the slope function. This is a fantastic little statistical tool. Its claim to fame in finance: calculating a stock's beta. All that means is it tells you how jumpy a stock's price is compared to the rest of the market. It's a really core way to measure risk. And last but not least, for the master chefs in the room, we have MULT. This one's a bit of a beast. It multiplies big grids of numbers. Why on earth would you do that? Well, if you're trying to build the absolute perfect portfolio out of hundreds of different stocks and bonds, this is the power tool you need to do it.
So when you put it all together, from valuing an entire company to managing your worst-case risk, these financial recipes, they're amazing tools. They take this messy, complex world and they give us some clarity. But, and this is the big but, we have to end with a really important question. All these models, all these spreadsheets, they're built on assumptions about what people are going to do next. So can a spreadsheet, no matter how clever it is, really predict human behavior? The chaos, the emotion, the brilliant and sometimes crazy decisions we all make? That is the limit of every model. And it's the one question every great financial mind never ever stops asking.